here and share this information with you guys. We try to keep it simple so that everyone would understand and everyone be able to benefit from this information. Okay. So I'm going to jump right into it and just share this information with you guys. Let me see here. Yeah. All right. So here we go. Let me share my screen and get myself in slide mode. And here we are. All right, trust that you can all see my screen. Let me get my other monitor together. I had you guys in the top corner. I want you a little closer to me. So here we go. All righty. So we're happy, like my host said, my name is John Robinson. I'm excited about bringing this information to the community, and we want everybody to be informed. I really believe that people suffer and perish for the lack of knowledge. And it's like anything, we had many people to really suffer during the pandemic because they didn't have knowledge. They wasn't aware of the very basic things that needed to be done. And so I just got my stopwatch on because when I get excited about these topics, I get to talking and then I use all of my 52 slides. So y'all don't want me to do that today, right? Just a few that I got. All right. So let's get into it. And our topic for today is put your money to work. And this is part 4. We've been talking on this series. We've talked about several topics in this series, put your money to work. Because our money is not just to pile up in the bank or to go in and out of the bank. We can put our money to work to whereas we're not the only one always working. The goal that I have is that I have enough money working for me that I don't have to be getting up in the morning and going to work. And so why go to work for money when you can put money to go to work for you? All right. So we started talking about, we're going to talk about savings. We're going to talk about loans. We're going to talk about investments. But this week, we're only going to get to savings. Next week, we'll do part 4B. We'll get into loans, and then we'll get into investments. So the thing about it is, savings, loans, and investments. We're going to talk about the good, the better, and the best. We used to say the good, the bad, and the ugly. I'm not interested in the bad and the ugly. I'm interested in the better and the best because that's what I want for my family. So we're going to talk about savings. We're going to talk about loans and investments. Now, when it comes to savings, it's 7, but actually I added a couple more. But most people know 7 different types of savings. And, you have your traditional savings account, your high yield savings account, your certificates of deposit, so your CDs. And yes, those CDs are not, they're not, Taylor Swift or whoever. These CDs are certificate of deposits. And I had a friend of mine, a business associate, said, first time he went into a bank and saw the sign that said CDs, he wanted to know what kind of music the bank was selling. But I'm sure some people still struggle with that. But money market accounts, savings bonds, cash management accounts, and health savings accounts. Then I got 2 more for you. So let's jump into it. Traditional savings accounts, most people are aware of those, and you earn interest. But the biggest complaint I get about the regular savings accounts is what? Your money don't hardly make any money. I have an associate that was charged to manage some money in a savings account for a parent, and this account was 6 figures, and yet still the account barely made about $5 or $10 a year. It's like, what is this, right? So that's the thing about savings account, traditional savings account. If you look at the average Well, that's in 2023. It's a little bit more now. But that back then, the average was 0.37%. And even if that doubled or tripled, it's still not much money to talk about. But your traditional savings account is there, it's available. Um, the money's accessible, and sometimes there are fees and sometimes not, depending on the institution that you're using. So that's your traditional savings account. Then you have your high yield savings account. Now, those have been around for quite some time, but they really wasn't doing a whole lot these past few years. But now they're back in, fashion, and they're paying like up to like 4%, some 3.5, some 4. And I've heard of a couple out there that, supposedly paying 5%. But like anything else, you have to look around and compare uh, the interest rates you're going to get based on the institution you're using. And then you also need to look at the rules that govern those accounts and look at fees. For example, some high yield savings account, um, they offer higher, but some of them don't want you uh, to have any kind of withdrawals or a lot of activity. They limit how many times you can access the account. So that is something that you may want to keep in mind. If you normally have a lot of activity in your account, well, then uh, some of these accounts have fees that apply, or they have limitations in order for you to earn that high interest rate. Okay, so uh, a lot of them can be found online. This type of account is best if you don't mind managing your account over the internet or through mobile banking, right? So you got to look at accessibility and different things like that. All right, certificates of deposit, CDs. All right, a certificate of deposit is a type of savings account that earns a fixed interest rate on a lump sum for a specific period. So a lot of times you can get a 6-month CD, uh, you know, maybe a 90-day, but those are not as common. But a 6-month CD, 1 year or 2-year CD. So you have to be willing to tie your money up for a specific period of time in order to get that higher yield. As a matter of fact, um, in today's economy, sometimes things get flipped around, right? So normally your CDs will earn you more than your savings accounts. But now, the way the economy is, and now with the presence, and then again, regained popularity of high yield savings accounts, well, the CDs don't look so good. The high yield savings account a lot of times will do the same or better, but it just depends on what's going on in the economy. All right. So some of them have penalties if you try to access your money. And so if you're going to get 4% on a CD or 5% in a CD, but you can't touch your money, or you can get 4.5 or 4% on a high yield savings account with more accessibility, that's something that you want to consider, that you want to, based on your spending habits or saving habits, you may want to look into that and see which one would best suit you and your lifestyle. All right. So that's your CDs. And then money market accounts. So you have your money market accounts or interest bearing accounts offered by banks and credit unions. So you can get them at both banks and credit unions, and they can be used to meet your short and long-term savings goals, right? So you can withdraw from the money market account at any time, right? But you got to use using checks or a debit card. And although some banks may place limitations on how many withdrawals you can make, right? So here you go, you got your money market account. It's more readily accessible a certain way, and um, and then you have to watch for the limitations that govern them. All right. So credit unions, your bank or credit union may also require a minimum deposit. So that's a lot of these accounts carry a minimum deposit with them. In order for you to earn the benefits of these accounts, then you have to go along with the requirements and in many cases a minimum deposit or a minimum balance on these accounts are required, right? Now, let's look at the pros and the cons of a money market account. Uh, like we said earlier, your money is usually available whenever you need it. Many money market accounts allow you to write checks on the account. Y'all know what checks are? People still do checks. I do have a couple checking accounts, and yes, because I have commercial checking accounts, I still do checks every now and then, right? Right. So many money market accounts offer competitive rates higher than traditional savings account, right? But a lot of times, like we talked about some minimum balances that you may have to keep there, but your money market account is secure if the funds are held in an FDIC or NCUA insured bank or credit union up to 250,000 per depositor, right? So if you've got 250,000 or less in that bank or credit union in a money market account, and that bank or credit union does participate and is FDIC insured, well, then up to $250,000 of your money is protected. All right. Beyond that, then, beyond that, it may not be so protected. And so we saw that a year or two ago when we had a couple of companies crash, and I think the gentleman by the name of Sam Bankman-Fried was involved, and so we had what they call a run on the bank, and so a lot of people were concerned about their funds, and there are many people that have a lot of money in these accounts, 500 and 600 and 700,000. And they were very concerned about having only $250,000 of their money protected. So that's something that if you're gonna really save, if you really, especially when you talk about saving to do something major, then these are things that you must consider. Some of these high yield savings accounts offer higher rates than certain money market accounts, right? And it's possible that you may be restricted to 6 withdrawals per statement cycle at certain banks. All right, then you may have to meet the account's minimum balance requirements to earn the advertised interest earning and so on. All righty. Details, always very important. Savings bonds. Like I said, well, in our earlier session, earlier this week, savings bonds were very, very popular, back in the day when baby boomers were young. All right, they're still available. But now there's so many different ways of saving and increasing your funds that that they're not as popular as they used to be, right? And of course, there's Series E or Series I, and it's a long-term thing. It's a secure thing. The government offers it, but it's a long-term thing. It's not. It doesn't yield results and interest as quickly as some of the other programs or other forms of savings, but they are there and they're available, and people like to. As a matter of fact, some people like to use savings bonds because the money is not that readily available. It's a discipline thing for some people. They want to put away money for college for the kids or so on, and they don't trust themselves to leave it alone. So they participate in savings bonds so that when it's mature, it's kind of when they need it, and so on and so forth. So savings bond, number 5. All right, now pros and cons. Here again, the savings bonds earn interest monthly, which is good. The Series EE bonds are guaranteed by the government to double in value if you hold them at least 20 years. 20 years. In some cases, 30 years is the maturity date. So, many people want their funds, their money to double quicker than that. Matter of fact, if you have a good yielding account that's yielding somewhere around 8%, then your money can double in about 10 years or less. And that's kind of what most people prefer today, right? So you're guaranteed to get back the full value of your savings bond plus interest if you keep it until maturity. All right. So there is a purchase limit, 10,000, on both electronic Series EE and Series I bonds, 20,000 total in 1 year. So here again, you have your limits based on the program, and depends on how involved the program is with government regulations and so on and so forth. There are some other limits involved. So savings bonds, that's number 5. Now let's look at number 6, which is cash management accounts. All right. Cash management accounts, or the CMAs, are non-bank accounts. Non-bank accounts that let you manage your money and combine some of the same features of a savings and a checking and an investment account all in one place, right? So they typically earn competitive interest rates, and you can withdraw your money at any time with no penalty. So the CMAs also have very few, if any, account or ATM fees, although this vary depending on the financial institution. So this is a non-bank institutions, and most of them cannot offer the FDIC insurance coverage unless they have some type of a link or affiliation with a third-party bank, right? So if you got to see brick and mortar, if you got to see a building and tellers and all of that, then this may not be the thing for you. All right. So CMAs, or cash management accounts, allow you to seamlessly manage your investments and banking accounts all in one place instead of many, right? They're an interest on the money you deposit, right? The interest you earn are competitive and may provide more interest than interest earning checking accounts, right? If your CMA is linked to one of those partner banks, then it may be insured for more than the legal maximum FDIC insurance. So there is an additional pro there, right? So you won't find the face-to-face customer service, right? The face-to-face customer service or range of services that you're accustomed to in a bank or credit union, right? So if you got to see somebody, if you got to shake hands and look in eyeballs and all of that, then this may not be the program for you. It's usually they have a high minimum balance, and as far as requirements are concerned, compared to standard savings or checking account. And they typically offer lower rates than with other savings account options. So these are the pros and the cons. Sometimes you can get a higher rate, a lower rate than in the than doing maybe a high yield savings account, but that doesn't allow you to manage investments and savings seamlessly at the same time. So it just depends on, your activity or your goals, your financial goals, and so on. All right, what we got here? Number 7, health savings account. Health savings account. So the health savings account, I want to say they're probably about 20 years old, roughly, maybe a little bit less than that. But these accounts are very good, especially if you're working with a company and you're able to get insurance because of group health insurance and different things like that. And you're having a health challenge and there are deductibles and copays involved. And so I know people that go to the doctor a lot and they need a lot of care, but they're still working, they're still productive. And so, in order to manage that, they will use a health savings account, help them with their co-pays, and they're able to put money away. If they have a good year and they don't have a lot of doctor visits, good, they have some money. But if they have a tough year and they have a lot of doctor visits and co-pays and deductibles, well, the health savings account helps you to do that. And there's some other advantages. There's some companies that would even help contribute to your health savings account, and there's some tax advantages there. So if a person has a lot of health challenges, I really recommend that they can just look into some of that if the company they're working with offers that, right? Then, of course, you have annuities. Uh, I got the 8-1 annuities, and then the number 9 is life insurance programs. And for the time's sake, I'm going to kind of go through this real quickly. But, the annuities are, financial product that offer guaranteed income stream and usually, they're usually bought by retirees. When you save money in a 401k, one of these programs, the 401k especially, it's not a program for paying out. It's a program for taking in money. So once you're ready to retire, then you want to move those funds to an annuity that is set up to help you, receive a lifetime income, help you manage the tax situation. Some of them would pay monthly, or they will pay you semi-annually or quarterly or annually. You get to decide that. A lot of time they'll let you decide if you want to pay the taxes on the funds, or if you would like them to take the taxes out to help you with that. And so they're very flexible, but they allow a person to create a lifetime income for the most part. And this is definitely very important, especially the baby boomers right now. So I'm just going to give you a quick little, oh man, my time is gone, but cash value life insurance policies, it's a long-term savings plus protection. All right. And some of these programs have tax advantages, and there's a whole lot more that I could say about that. But one thing I do want to say is, this program would allow you to save for a lifetime tax-free retirement income. All right. So look, next week we're going to talk about loans, and I just want to kind of give you guys an idea of how many loans are out there. I mean, how many different types of loans? There are a ton of it. And then likewise investments. But that's going to be our next week topic. So, hey, I've enjoyed sharing this information. I don't know where the time goes to. I'm just getting cranked up. But we appreciate you allowing us to share this information with the community. Let your friends and family know about it. This is free of charge information. No one is collecting anyone's data or anything of the sort. We're just putting this information out because we're building a community, and an educated community, it's always a better off community.